My name is Jake, welcome to the channel. In today's video, we're gonna do a Review My Pie video where I review subscriber portfolios. I love this series. It's different from the other videos here on my channel. I see it more as a casual conversation between you and me, just sitting down, talking about dividend investing, nerding out on dividend portfolios and all that kind of stuff. And so I really try to take more of a laid back approach to these type of videos, and it's a good thing because I'm noticing that my voice is a little bit scratchy, and so I'm hoping that I can even finish this video because these Review My Pies are generally a little bit longer. I might even cut it a little bit short today, but long story short, I've been trying this new. Not to get into too many details, I have a mild case of asthma, and I've noticed it get a little bit worse these last couple of years. And so I'm on this new inhaler. I've never taken an inhaler my entire life. And so I'm trying this new, and I have like a powder one. And sometimes it makes my voice kind of scratchy. And that's what I'm dealing with today. So this morning I was like, okay, am I even going to be able to make this video? And that video a couple weeks ago with my wife, I was having it as well. So this is the second day where I'm noticing that my voice is a little scratchy. So it's like, and just like my laugh is like, it's just weird. Just bear with me, and hopefully it'll be okay. I'm excited to share that this video is presented by Snowball Analytics. Snowball Analytics is a tool that I use to analyze my dividend portfolio. You can check them out with the link in the description below and use promo code DGI to get the very best pricing. So in today's Review My Pie, we're going to take a look at a question, and we're going to take a look at 3 portfolios. The first portfolio is going to be from a 21-year-old here in the United States, the second a 33-year-old from the United States, and then the third a 51-year-old from the United States. And as always, everybody, please don't take what I'm saying as financial advice. This is just merely for your entertainment. And as always, the timestamps will be in the description below, as well as the portfolio links. And as always, everybody, I don't review the portfolios in advance, so I'm reviewing them as I'm recording. So I don't pre-script or pre-record any of this. It's all, just doing it as I see it. But yeah, investing in the stock market can be scary. It's not as scary, when the stock market is at all-time highs, like every single day. October is usually a scary month, not only because of Halloween, but because usually you have a lot more volatility. Well, this year is not the case. Every single day is green, at least what it feels like. But I will say, don't get too ahead of ourselves, right? The market likes to humble us from time to time. And, when the inevitable market correction or recession, whether that be 5%, 10%, 20%, or whatever, I'm not, Ray Dalio or anybody, Michael Burry, I'm not calling any top or anything like that. When the market's doing well, everybody is generally doing well, especially growth investors. And, when the market's not doing so well, growth investors tend to get scared more than value investors. And so growth investors are going to get a lot more scared than dividend investors in the next market recession. And, it's important to remind yourself of that. And I guess, it could probably look a little like this.
Trick or treat. Come closer and I'll give you a real
Oh my gosh. Oh man. All right, cool. So here really quick, before I forget, I do this once a week. If you want to book time with me directly and you want to talk about your portfolio, or you just want to talk to someone about your strategy, your portfolio, you're struggling and you don't have anybody in your family or your friend circle to talk about this kind of stuff, you can book time directly with me. I do this once a week. It's all through Google Meet. I really enjoy the conversations that I have. I really try to take my time with the people that book time with me. I don't try to rush things. I try to make it as useful as I can without giving actual financial advice, saying what to buy and sell. So if you're interested in it, you can book time with me. I'd be very happy to meet you. All right, so the question here is from Luke. He writes, "Hello, I've been watching some of your videos recently and you've gotten me pretty hooked. I don't have much money to spare, so I'd like to use it as efficiently when the opportunity arises. I apologize if you've already done a video about this, but my question is this. If the market were to crash in the near future, what ticker would you go into most heavily? Something broad or reliable, broad and reliable like SHD, or a specific company you would be well placed in Excel. Sorry if this has been answered already. Thank you for your time." Well, Luke, thank you so much for reaching out. So this is a really good question. What I would recommend is I would have a watch list of individual stocks, ETFs, if you're investing in individual stocks. The important thing is to have a watch list of what you're keeping an eye on. So what you're going to want to do is you're going to want to kind of understand what has been the historical, dividend yield of an ETF, a dividend stock, so that you can know if it's a really good bargain. And what I've noticed is in market crashes and corrections, growth tends to get hit the hardest. So in a correction, I tend to like to invest more heavily if, assuming that you're working a day job, you're dollar cost averaging. Because if you're not dollar cost averaging, don't worry about market crashes. Focus on, dollar cost averaging, right? And if you want to keep some dry powder on the side, that's kind of like in my mouth right now because my voice is like dry and I can hear it. And let me drink some water here. I'm going to keep that in there and not cut it so that you can hear the difference. So I'm going to keep that in there too. But the important thing here is to not forget that you should still be dollar cost averaging. Yes, I understand that you're not investing a lot. You don't have a lot of money right now, or in general, that's completely fine. You want to make sure that you're not trying to overtime the market, because what's important is time in the market and not timing the market. So with that assumption, assuming that you're dollar cost averaging, if you want to keep a little bit of money on the side and have a watch list of stocks, ETFs, I think that can be a really good idea. And what I would always recommend is look at more like growth ETFs, right? Like when the market crashes, generally technology crashes more. And so I like ETFs like DGROs, or even JEPQ if you're in that time horizon, right? You could look at those more growth-focused ETFs that get hit harder, and so you could take advantage of the extended the elevated volatility. And so what I always do is I look at the historical average of the dividend yield, and once it reaches a good healthy level, like for example with me, every time the DGRO gets a starting dividend yield of 2.5%, that's like a really good buying opportunity, in my opinion. At least that's what it's been historically. Now with SCHD or more value stocks, yes, they get hit in a correction, but not nearly as much as a growth stock. And so that's what I would recommend is if you're looking to take advantage of take advantage of crashes or corrections, I would look for opportunities where you're going to get the most bang for your buck. And that's generally going to be in higher beta, higher volatility sectors. And that's what I would recommend there. So pretty simple. Just remember, make sure that you're always buying, focus on time in the market and not timing the market. And I think, you're going to be, in most cases, much better off. And it takes a lot of the emotions out of it. And it makes buying the dip and taking advantage of those corrections, makes it a lot more fulfilling when you've planned and prepared for it. So make sure that you have your watch list. Don't do this emotionally. Do it, strategically. And I think that's how, most people should approach that. But yeah, thank you so much for sending over the question. I hope that helps. All right, the first portfolio is from Carlos. He writes, "Hey Jake, my name is Carlos. I'm 21 years old. My plan is to retire before 40. Been investing since 18 years old, and I'm all over the place with investing, so I need some guidance. This is my M1 investing account. I have all ETFs, mostly dividend, but a few growth ones. I also invest into Bitcoin, about 2K currently, total of 23,000 invested so far at 21 years old, man. That's awesome. But wait, there's more. I also, the Mr. Clean makes me think of that. But wait, there's more. Or what is that one guy that, Mr. Clean. I also have about 30K in my Webull investment account, but in one single stock ACHR. I'm currently losing about 8K on that. I also have 21K sitting in the bank in case of an emergency. And also that's my savings to buy a house with my wife in the future. Please, I really need some advice. Thank you. Well, Carlos, I probably should have taken some advice from you when I was 21 years old because I wasn't thinking about this kind of stuff at 18 or 21. So kudos to you. First off, you're currently losing 8K. Did you sell or are you down? You only lose money if you sell, right? So it's important to understand that. And it sounds like, when you get over concentrated in a stock, you're either a genius or an idiot, okay? And right now you probably feel like an idiot because you're down. And so what I always recommend is avoid the scenario where you're either an idiot or a genius. And a way that you can do that is set guidelines for yourself, right? Say to yourself, for example, don't invest into one single stock at more than 5% of your overall portfolio. That's a guideline. Whether you follow it or not, it's up to you, but that's something that will help you to stay on track. What you're missing is a North Star. Right now, you're kind of just drifting about, you've got a little bit of here, a little bit there, but you don't have a North Star. Your North Star should be, okay, I'm planning to retire at 40. How do I invest? What do I invest my money in and my time so that I can reach that goal? So never forget that your North Star is that retirement, date, but what's going to help you get there? What investment vehicles are going to help you reach that goal? And there's no one size fits all. All right, so let's take a look at your portfolio. So you're 21 years old and you have about a 20-year time horizon. You're invested into 14 holdings, mostly ETFs. You got JEPI, JEPQ, you got SCHD, you got SPY, you got VYM, you got DGRO, you got GPIQ, GPIX, QQQM, you got QQQI, Realty Income, SCHY, SCHG, and VOO. So my friend, Carlos, you got this backwards, man. You're doing this wrong. So I'm glad that you reached out because you're doing it wrong. Okay. What you want to focus on is first off, you have to understand growth rates, right? What I would recommend you do is go and Google the rule of 72. Understand compound interest and understand how each investment is compounding and growing over time, okay? What you don't want to do when you have a long-term time horizon is invest in a covered call ETFs. That is the wrong thing. You do not want to do this, okay? Especially with a 20-year time horizon where you're reinvesting the dividends, you're paying taxes on those distributions every year, right? You don't want to do this. So before I forget, I'm going to have a video pop up at the end of this video. It's, things that I wish I would have known 20 years ago. And it was a video that I made a couple of weeks ago. And it's where I go very, very into detail about how to invest based off of your investment time horizon and treating your portfolio like a target date fund. Okay, so that video I will have pop up at the end. I don't want to repeat myself and everything that I shared in that video. So if you're interested in that, go watch that video after this. But what you want to do is you want to do this backwards. Okay, right now with a 20-year time horizon, you want to go heavy in VOO, SCHG, maybe SCHY, QQQM, DGRO, SCHD. And in my opinion, I would take out all of your covered call ETFs. Take them out. Right now, you're currently getting a dividend yield of 7%. If you take out those covered call ETFs, you're probably going to have a dividend yield of around 2%, 2.5%. And that's good. You don't need the dividend today. You said that you need it in 20 years, so get rid of them, okay? Don't put them at 1%, though you could, but if it was me, if I can convince you, I don't want to convince anybody to do anything. I'm hoping to give you the tools and understanding so that you can make the decision for yourself. If it was me, and if I had 20 years, let me tell you what I would do. I would get rid of all of those covered call ETFs, every single one of them, and I would have probably, 20 or 30, 40%, 50% into SCHD. I'd have a big chunk into DGRO, maybe a little bit into VYM, maybe a little bit into QQQM and VOO for growth. and, SCHG for growth. And I would focus on that. And then as you get closer to your date in 20 years, then you look to rebalance and reallocate into different holdings. And that's what I share in detail in that other video. So what I don't want you to believe falsely that more is better. What I would recommend is go back to the drawing board entirely. I would start over entirely, and I would look at something like the core and satellite. I would have 50%, I would have 40 or 50% SHD, DGRO, both of them, and then I probably have 20 or 30% into growth ETFs like SCHG or VOO. And then for the next 10 years, just dollar cost average into that. Focus on making money in your career. Stop stressing about your portfolio and build real wealth. Yes, you can get lucky with Bitcoin. You can get lucky with a single stock, but that shouldn't be your plan A. That should be kind of your ace in the pocket, your ace in the hole there, your wild card, right? That's great. But you don't want to plan on it being the case that you're going to get rich overnight with that. It took me 10 years to build my wealth, and it was through blood, sweat, and tears at my day job, side hustling, and real estate. There's many ways that you can do it. The odds are against you to pick the right stock at the right time and sell it at the right time, and do that consistently over and over again. If you can do it, great. You shouldn't be watching my channel. You should be selling a course if you can do that, right? Unfortunately, most people can't do that. And even the self-proclaimed ones that say they can, they really can't consistently over time. So a more tried and true approach to this is keep it simple. Keep it simple and focus on the basics. Stay out of consumer debt. Don't spend more than you make, and try to make a little bit more money. You're 21 years old. You're not in your golden years. Focus on getting a promotion at work, start a business, get more efficient. How can you make more money? How can you go from, contributing $100 a week into your portfolio to $200, to $500? How do you then go from that to then contributing $1,000 a week? That's going to move the needle. It's not going to be possible for everyone, but that's how you want to think about this, and not think about how do I pick the right stock or shiny object to get rich off of. Okay? It works for some people, but it doesn't work for the majority of us. That's my honest opinion. But if you want more information on the target date fund and the time horizon stuff, go watch that other video. I think it'll help you a lot. And set some guidelines. Make sure that you're understanding what you're trying to accomplish and work backwards. 20 years is a long time. A lot of things are going to happen in that time period. You might have, married, kids, house, all that good stuff. There's a lot coming your way. Set a foundation and don't try to get rich quickly. Just focus on the basics. Thank you so much for sending over your portfolio. The next portfolio here is from Keith, who writes, "Hey, recently started watching you and you seem to have a pretty honest take on things, which I liked. So I'm 33 years old and I have about $4.5 thousand invested into a traditional IRA. I'm looking to retire onto a homestead in a 10-year time frame. I won't need a crazy amount, honestly, just need to subsidize working for a few things we can't make happen at home, like toiletries and random things. I live in California and assume that the traditional IRA would be better since where I end up will have a lower income tax. So with the traditional IRA, you save taxes up front, when you're working, and then later at the age of 59 and a half, you have to pay taxes. It's the opposite of a Roth IRA where you do the reverse. So I'm having second guesses on this now, though, and feel like maybe I focus on a Roth IRA instead of the traditional. I'm trying to get 60% into SCHD and SCHG. So 60%, so probably, 30% SCHD, 30% SCHG, and then 20% into Maine and 20% into VIG. Ooh, that's spooky. It's very, very on brand for the season here in Halloween. You're getting spooky with me. You know if you know. I would likely be needing to stop dripping the dividends in around 10 years time from now and have no plans on pulling the bulk amount out. I aim to just max out either the Roth or traditional IRA each year and to keep the spread the same unless you have a suggestion. Well, Keith, thank you so much for sending over your portfolio and I guess your question here. So first off, I think you kind of already answered your question yourself because, the traditional IRA is great while you're earning money, you're working a day job, and you need that tax deduction now. Now, if you know or assume that your taxes are going to go down because in the future you're not going to be working, no longer have a W-2, or your income is going to be dramatically lower, well, you don't need the tax savings, later. You need them now, right? So the traditional right now, while you're making money, sounds right. And then what you could always do is once you quit here in 10 years, your mid 40s, you're probably not going to be making a lot of money. What you could probably do is plan a small amount. You could, you could do a conversion of your traditional IRA or part of it into a Roth IRA and pay the taxes in the year that you convert the account. And so the benefit of that is you can control when you pay the taxes, in which year, and how much. So I would always recommend looking at a strategy like that. In fact, that is exactly what I did. If I stopped working in 2023, I converted my employer 401k into my Roth IRA. We didn't make a lot of money in 2023, so I paid the taxes. We were in a much lower tax bracket. So I was like, yeah, why would I not do that? And so there's a lot of little strategies that you can look at to optimize the taxes. And something that's so important, I talked about this with my wife this week because my wife is no longer working. She's retired now. And we were talking about, well, how can she contribute to our finances? And I said, you know what? Making money is not what it's always about. Saving money is making money, not overspending on groceries, not overspending on commodities, different things. Saving money is making money. And so if you can save money by optimizing your taxes, absolutely, that can be a great idea. But I think you're kind of missing something here unless you're going to do what's called a Roth conversion ladder. How are you going to access your retirement accounts at 43, right? You said you're 33 and you want to retire in your mid 40s. How are you going to access this money in your retirement account? So maybe you need to rethink this strategy and not invest all of your money in a, tax sheltered account like a traditional or, Roth IRA. Maybe you need to start focusing on a taxable brokerage so you can access that money penalty free before the age of 59 and a half. Now, you could do what's called a Roth IRA conversion ladder, but that takes a lot of work and planning and timing. So you'll want to research that. There's a lot of great articles and videos on that strategy, but it sounds like you probably need to focus more on a taxable account. Okay. So you don't talk about that. So it seems like, the reason why this is so difficult is conventional wisdom says, max out your 401k, max out your IRA. For most people, that's the right thing to do. But most people don't retire in their 40s. So if you want to live a different life, you have to take a different approach and be different than other people. Now, it might feel weird because you're going against the grain, you're going against what the norm says, but if you understand what you're trying to do, then it's okay. I personally struggled with that years ago when I was exactly in your situation. I'm 10 years out. What do? I don't want to wait until I'm 59. Well, I guess I'll have to do, invest into my traditional, my taxable account. And then I was like, but what about the tax savings? Well, I want to live a different life. I have to take a different approach. So it's important that you understand that and have a strategy for your taxable account as well as your tax advantaged account. Okay, so that's that piece, right? Now coming to your investments, 30% SEHD, 30% SHG, completely fine. This 20% in Main Street Capital, I think is an absolute abomination. Abominable. disgrace. No, it's just too much, man. 20%. Like, no, if you've been following my channel, I always recommend not having more than 5% into an individual stock. Now, there may be a chance that you think that Main is an ETF. Main Street Capital is not an ETF. It is a BDC. It's a business development company or whatever they're called, right? This is an individual company, okay? You don't want to do this, in my opinion, okay? Now, your dividend yield will probably go down. So there's other companies out there like Aris, and I think it's like Blue Owl Capital. I think there's a few of them that are publicly traded. You know, this private, they're in private credit, I think, if I'm not mistaken. You know, it's a kind of a hot topic right now because people are saying, you know, if you watch CNBC, they talk a lot about the risks in private credit. So be it, whatever. But what you could do is you could spread out that money across different BDCs like Main Street Capital, RS, you know, there's a few of them out there. But I would not go 20% in any individual stock because it comes back to what I was talking about earlier with the previous, you know, question here is, or portfolio, you're either a genius or an idiot. And my whole approach is avoiding the dilemma of the situation where you're either a genius or an idiot. There's got to be a different path where you're just kind of normal, right? Where you don't have to be so far in either direction. I try to kind of go the middle ground and not be a genius or an idiot. I just kind of want to be, you know, in the middle. And so what I would recommend is I'd actually recommend that you watch this video as well that I was talking about earlier with the things that I wish I would have known earlier. And I talk about how to build a dividend portfolio in terms of like with the math. I talk about target date funds. I think that video would also be useful and helpful for you to kind of understand this a little bit better. But that's what I would recommend here. We touched on a few different things, but I hope that that's helpful. I love SHD, VIG or DGRO. Pick whichever one you want, VIG or DGRO. I would not get both of them. I would do either or. Both of them are fine. And just make sure that you understand the math of your portfolio allocation so that it meets your goals within your 10-year time horizon and treat it like a target date fund like I've been talking about, you know, here on the channel. So with that, thank you so much for sending over your portfolio. I hope that that helps. All right, the last portfolio here is from Matt. Matt writes, "Hi Jake, I really appreciate your channel. I wish I'd found you sooner than I did, and I realized how close my wife and I are to retiring much sooner still. We are 50 and 51 and are hoping to have our consumer debt behind us by the end of 2025 so we can start investing towards retirement." I'm so happy for you, Matt. You know, 50, it's better late than never. I'm sure you're probably going to do the Dave Ramsey scream or whatever it may be. You know, it's so, you know, debt is just, it's like, it's evil. Debt is evil. You know, it's bad. You know, not all debt is created equal. Consumer debt, it puts chains around you. It enslaves you into the system. And I'm just really, really happy for you that you're getting out of that. You continue writing here, "Thankfully, I should have a decent Social Security payment coming when I'm 67, and I don't intend to fully retire at that point even, just to slow down a fair bit. I don't know that we're in trouble, but I would like to see us get an investment portfolio together by that time that's somewhere between 300 and 400,000 so as to generate plus or minus $1,000 a month in dividends to make sure we have what we need. And of course, we can't 100% count on Social Security 16 years from now either. Once our debts are behind us, it seems reasonable to assume we could pull off maxing out our Roth contributions each year, but not much more. With that in mind, I've constructed the following pies, plural, in 5-year increments leading up to our retirement. I don't have to know how to turn them into pie charts, but the info is there. So some notes. I'm hoping growth and broad market ETFs bought early will have time to become significant and then turned into, DGRO and more SHD in roughly a 5-year period during the last accumulation phase, giving room to sell them at relatively high points. I really like that. So just making sure that I keep there's a lot to consider in this email. So the first part is you're going to invest into growth with the intention of rebalancing in 5 years. Hopefully the market should appreciate, and then you'll have more by, rebalancing in the future. I like that approach. I've gone heavy into tech early as well, with AI and other developments on the horizon, shifting to more broad growth in phase 2 with just SCHG. My wife isn't likely to get much in Social Security, so I'm thinking she could start collecting it at 62 and continue working with it without it affecting her income. That could also be put towards investments and or high yield interest cash accounts. So touching on this piece here really quick. So you're taking a multi-level approach to this. You're focusing on Social Security, your wife's Social Security, dividends, and your wife even potentially working part-time as well. So you're going to have multiple income streams. Moving on here, I've added your simple 4-fund portfolio in at the end for comparison with what I come up with. Granted, a lot can change, but does this plan leading to this retirement portfolio add up? Whether it does or not, could look at this even on one of your Review My Pie episodes, perhaps help other people who are 10 to 15 years from retirement and just starting to prepare. Thanks for all that you're doing to help us see what's possible, Matt. Well, Matt, thank you so much for the detailed email, for reaching out. And, you're in an interesting situation, right? You're in your early 50s, where you have a good amount of time before the traditional retirement age. So it's never late than ever, right? Sure. Obviously, I'm sure if I were to ask you, would you have wished that you started yesterday? The answer would have been yes. Do you wish you started 10 years ago? Obviously, yes. It's never too late. Obviously, yesterday was better, but the second best time is today. So the fact that you're getting rid of your debt and you're changing course, you're focusing on your retirement, you have the foundation. There's many different paths that you could approach this. And so I'm going to touch on a few things. When I meet people one-on-one in those calls, right? This is generally the kind of stuff that I'll walk through and talk with people. So for example, the first thing that you want to understand is what you're investing in and where you're investing it. Where you're investing it, in this case, because you're going to retire and live off the income after the age of 59 and a half, where you're investing should all be in retirement accounts. So every single dollar you invest should go in 401ks, IRAs, Roth IRAs, that kind of stuff, HSAs, and tax advantage accounts. After you've maxed out your IRAs, your 401ks, your HSAs, then can you put a single dollar in a taxable account if you have money left over, because you're retiring after the age of 59 and a half. That's the first thing. So where you invest your money. The next thing becomes what you invest your money in. There's generally 3 schools of thought. When you're thinking about investing, you can the first school, you can invest everything for growth. You buy low, you sell high. You buy a stock at $100, you sell it at $200 in the future. That's the first approach. The second approach is you buy a stock at $100 and it pays a 3% dividend, and you hold on to it and you never sell it. And you live off of that $3 and that 3%, and that 3% is growing each year ideally. Okay, so those are the first 2 schools of thought. The third school of thought is you do a combination of both. You do a little bit in the growth and you do a little bit in the dividend growth. And because you have a time horizon of about 10 years, I personally would recommend doing the third school of thought, where you have a percentage of your overall wealth and portfolio in growth and a percentage in dividend growth. Because you and I, no one knows what's going to happen. We could have a lost decade where growth doesn't go anywhere, right? We could have another dot-com bubble with AI, right? No one knows. Or we could have, the S&P 500 could quadruple because AI changes everything. You just don't know. So by focusing on the school of thought number 3, you're casting a wider net and acknowledging that you can't predict the future. And so you're dabbling a little bit in both. So that's what I would say for most people when they're in this situation. They consider those 3 schools of thought based off of what time horizon you're in. You want to do a percentage in whichever school of thought resonates with you. And here's the beautiful thing. There's no right or wrong. There's plenty of people out there that like to think that they know better. They use historical charts, they use historical literature, and they say that you're wrong and do only this. Let them do what they want. Let them think what they want. But I'm telling you and I could be wrong, in my personal humble opinion, there's many paths that can lead to success. You have those 3 schools of thought. Pick a school of thought that works for you. It's okay to change your mind throughout the process, but pick one that works for you. Okay, so with that understanding, you sent me a spreadsheet here of your whole portfolio and your ideas. I'm going to share it on the screen here, but I'm not going to go into too much detail into the year over year, but I'm going to share it on the screen. And the reason I want to share it on the screen is if there's someone else in your situation, maybe in their 50s or someone that, your story resonates with them, they can look at your approach, kind of see how you've looked at this, right? So you got your retirement account, you got your Schwab account, you got the different time horizons in 5-year buckets, right? You got 5-year, 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 and you got, you're seeing how you want to allocate this over time, kind of like a target date fund, kind of like how I talked about it in that video a few weeks ago, right? Where you're going to adjust the allocation over time. And you have multiple accounts, you said, for you and your wife. So there's many different ways that you can look at this. It looks like you have mutual funds. I don't know if these are index funds or mutual funds. Just make sure that you're looking at the expense ratio on this, right? I think this is like a growth fund and a S&P 500. Just make sure you're not paying a lot in the expense ratio, which I don't think you are. And so this is how you're doing it and making the math, right? Making it work. And you're factoring in other income streams like Social Security. Other people that I've talked to, they have real estate, right? They have a rental income, rental portfolio, they have Social Security, and they have dividend income, and so just kind of factoring in all of those things. And what you land on is this right here. So your proposed retirement portfolio. So remember, the goal here is in the next 10 years to generate $1,000 a month in income. And that's based off of a $300,000 to $400,000 portfolio. And I can see that you took the middle ground here of $350,000. So I'm going to assume we're talking about $350,000. You got 40% in SCHD, 25% DGRO, 5% VYM, 5% VYMI. That's the international version. You got SPYV at 5, JEPI at 6, JEPQ at 6, Devo at 3, and realty income at 5%. So I like the diversification. I like that portfolio. I do like it. And it looks like here the dividend, you're not capturing the weighted average dividend yield. So you actually have to do an Excel function to capture that. But I'll show you how you can do this here with a website in a second. But this 42%, that's not the average. That's the total, right? And so here you're seeing how much you're getting in income from this portfolio. So you're getting about $13,500, which is greater than your what you need. So if you take this 13,494 and you divide that by 350,000, your portfolio yields about 3.9%, give or take. So really quick, I'm sure that there's going to be a few of you out there that are maybe new to my channel, have never heard me say this. I'm sure there's going to be a few new investors out there thinking, well, SCHD yields 3.8% today. Why not just invest everything into SCHD? Well, there's a couple of reasons why you don't invest everything into SCHD. One of the reasons is for years like today, like 2025, 2024, 2023, SHD has dramatically underperformed the overall market because with SHD, you're only getting like 6 or 7% overlap with the overall market. So you're so focused on such a small percentage of the market. That's why combining SHD with other ETFs like GGRO, Devo, JEPQ, VYM is a smart idea. You don't want to just look at the yield. You want to look at the diversification and what each ETF, where you're at. What are you getting exposure to? So kudos to you for not going 100% into a single ETF like SHD, right? So really, really, really smart. And that's why I always say, combine it with an ETF like DGRO. That's why, I talk about the simple path to wealth with dividend investing, which was inspired by J.L. Collins. That's my thing, right? That's what I've been talking about for years. So kudos to you for not just going all into SHD. Let's take a look at this. So what is the portfolio here? So this is the portfolio that I have currently today, or this was my target allocation, here at the beginning of the year. It's been a little bit different because, in April we had the big market correction. So my portfolio looks a little bit different than this. And I've shared updates on that as well. But, let's take a look at the math and see if the math is mathing. So if we take a look at this with SHD, DGRO, JEPQ, and JEPI with these weightings at 40, 30, 20, and 10, and if we take the current dividend yield of 3.8% with SHD, 2% with DGRO, and 10% with JEPQ, and 8% give or take with JEPI, you'll notice that we have a weighted average dividend yield of just under 5%, 4.9. And if you recall, your portfolio has a dividend yield of right around 3.9%. So you could do it your approach, or you could do it with an approach like this and just kind of figure out what makes more sense to you, what is easier. But also what you want to factor in is you want to also understand, well, what percentage is your portfolio growing on an annual basis? So with this, we could take a conservative 8% with SHD, 9% DGRO. We could take 2% with JEPQ, 2% with JEPI, or 1%, just assuming no growth with these covered call ETFs. And you'll see that with a portfolio like this, you're still getting over 6% with the dividend growth. So let's go ahead and let's take this, 13,494. Now, this was your portfolio, your income. Now, I don't know what the dividend growth is with yours, but let's take 350,000. We times that by 4.92. This is with my portfolio, the 40, 30, 20, 10. So if we take this portfolio, you're going to have 17,000 in income. Divide that by 12. Well, you're going to overshoot the amount of income that you're aiming for, right? So with my portfolio as an example, it's just an example portfolio. With this example portfolio with SHD, DGRO, JEPQ, and JEPI, you're going to generate around 1,400 on an annual basis, averaged out on a monthly basis, right? So what is this income, right? This 17,220. How much is this going to grow on an annual basis? Well, if you take the annual growth rates averaged out over time, well, that income is going to grow about 6% on average. Some years it'll be lower, some years it'll be higher. But you take that and you grow it after 2 years, it's going to be around 19,000. And every single year, it's going to be growing right around 6%. So you can do the math. So that's how you want to look at this. You want to look at the math in terms of the weighted average dividend yield and the weighted average dividend growth rate. And you want to compare that with your portfolio versus, another alternative portfolio like the simple path with SHD, DGRO as an example. And with $350,000, it looks like with either portfolio, your proposed portfolio or the simple path, you're going to have it, over $1,000 anyways. So you'll be faced with the question, well, do we retire sooner or do we focus more on a growthier portfolio, right? Because you did mention that, Social Security may not be there in 16 years. So you may want to focus on a higher growth rate so that in the future you can overcompensate on the growth with the assumption that maybe Social Security isn't there. And so you can kind of weigh the pros and cons based off of where you're at that point in time. But the key thing here is you'll have options, right? And you'll have options with either portfolio, your proposed portfolio or the Simple Path portfolio. But yeah, that is how you want to look at this. And you want to take a look at it and make the math work. And at the end of the day, it's just finding the investments that are going to work for you. And that's what it comes down to. And if you haven't watched that video that I've referenced a couple of times from a couple of weeks ago, the things that I wish I would have known, I go into more detail about this and kind of build upon what I just shared in that other video. I think it might be of interest and interesting for those of you that haven't seen it or want to rewatch that. But yeah, thank you so much for sending over your portfolio. I hope that this is helpful. Congratulations again. I'm so happy for you to get rid of, be out of debt by the end of this year. It's a huge accomplishment. And then it goes from having a negative net worth to really accumulating and growing your wealth. Thank you so much for sending over your portfolio. I hope that the video was helpful. I hope that you learned something new. Hopefully I'm sharing my honest thoughts and opinions in these videos, and maybe you agree with me, maybe you don't, but regardless, thank you so much for watching. But yeah, I'd love to hear your thoughts. If you haven't already, go check out Snowball Analytics, and thank you so much for watching, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.